Well, the Bank of Canada did a whole lot of nothing today with respect to the direction of interest rates or any indications that they may move rates up faster or slower or anything else for that matter. But that didn't stop the media from jumping all over the conversation, jumping all over the headlines and making it seem like interest rates could go up significantly faster than we ever thought possible, and also that they could potentially not go up very fast.
The definitive guide on how to manage your credit. Product, penalty, price, in that order. It's never been more important to get your mortgage right.
Okay, so the Bank of Canada did a whole lot of nothing today with respect to interest rates. They didn't increase them. They didn't provide any forward-looking guidance that would indicate that they may increase them faster. All that's probably going to come on January 26th when they release their monetary policy report. This meeting today, this announcement today, this press release today was all about just maintaining the status quo, and they very much did that. But before we get into all the details and we talk about how the media blew this up and how it's an interesting conversation going forward and what to look for going forward, go ahead, click that subscribe button, hit that like button, hit that notification bell. And don't forget about our race to 25,000 subscribers. We are just about at 20,000 subscribers right now. The amount of new subscribers is increasing. Thank you to each and every one of you who have already subscribed. When we get to 25,000 subscribers, we're going to give away $5,000 to one lucky winner to maybe pay down their debt or use for a down payment or pay off their portion of their mortgage or simply to do with whatever they like. Maybe they're going to go and spend it all. Who knows? Contribute to that economy and those higher inflation rates. Who knows? But in order to win, you have to be subscribed. So go ahead, click that subscribe button. It's free. It's easy. It's definitely worth it. And let's get into our discussion of the Bank of Canada and what today's meeting and today's press release tells us going forward. So let's start with this. First thing you need to know is typically after a Bank of Canada press release with respect to interest rates, there's typically a meeting scheduled or presentation scheduled for the following day. That'll happen tomorrow with the Deputy Governor. We'll get an indication of what they're really thinking from that meeting and from that presentation, more so than what we got from the press release today. And that'll sort of give us some guidance as to what they're thinking with respect to when January 26th rolls around. But for now, what we know is the Bank of Canada hasn't increased interest rates, and they gave no indication today that they are going to increase interest rates anytime sooner than April. That may come tomorrow, and it most certainly, if they're going to change things, will come January 26th when they release their monetary policy report. Now, that report goes through all the details of their monetary policy. It goes through the details of the economy and gives a pretty well-rounded view of where the Bank of Canada is at with respect to the statistics and what they're going to do going forward. But let's take a look real quick here and just kind of see what happened today with respect to the conversation that they're having. We'll start directly with the Bank of Canada's press release here and just take a look at what their headlines were and what most of the conversation centered around. So first and foremost, headline is Bank of Canada maintains policy rate and forward guidance. That was largely expected. There were some articles, which I'll get into in a second here, which were a little bit scary this morning with respect to what some people were predicting would come out of today's press release. But for the most part, they're keeping things the same. They're acknowledging a couple things. The Omicron COVID variant creates some uncertainty in the market, and definitely it's something that they're watching. Depending on how that plays out over the next month and a half, it's going to have some effect on interest rates going forward. They talked about the fact that Canada's economy grew by about 5.5% in the third quarter. This was largely expected. It's about 1.5% below what 2019 was, which means that they've still got some excess capacity that they're trying to catch up on. But the big news here was the jobs report and that there was a substantial amount of growth in jobs, bringing our job growth back to pre-2019, pre-pandemic levels, which is a good sign for the economy because as that starts to filter through and maybe there's a little bit of wage growth, that will potentially start to create a scenario where we're going to see the excess slack in the economy start to pick up, and therefore we will start to be in a position where we can start to see increasing interest rates. Now, here's the big thing though, and I want to point out this part at the bottom here. This is the last paragraph, and here's what they have to say. The economy continues to require considerable monetary policy support. So in other words, they still believe that the support that they are providing is necessary because of the effects of the pandemic. We remain committed to holding the policy interest rate at the effective lower bound until the economic slack is absorbed so that 2% inflation target is sustainably achieved. In the bank's October projection, this happens sometime in the middle quarters of 2022. We'll provide the appropriate degree of monetary policy stimulus to support the recovery and achieve the inflation target. So here's the big messaging today is based on the October numbers, they expect that middle quarters of 2022 is when the excess slack in the economy is going to be absorbed, but they are going to have a new report coming out in January, which could change that. And if that changes that, it could move up the timeline for interest rate increases, or it could push it back. Now, the economists that we talk to, the economists that we read on a daily basis, they're saying that the market is expecting about 5 interest rate increases over the next 12 months into the end of 2022. However, what they're projecting seems to be somewhere shy of that, maybe 3, which means interest rates would go up by about 0.75%. Now, going into a couple of the other articles here, there was definitely some fear instilled in the market today when BNN Bloomberg came out this morning. They released an article. This is not it because they've adjusted it, but they came out this morning and had an article from somebody, and I wish I would have saved a screenshot of it because they said that a January rate hike was likely. And when I saw this, instantly my heart sunk. I thought, have we been telling people the wrong things? And when I took a look at the article, I think it's pretty clear that we're not going to see a rate increase in January unless we see a significant rise in inflation over the next month and it becomes clear that that is becoming uncontrollable. So I don't expect a January interest rate increase, but that isn't stopping certain economists from saying that that is when it should happen. Now, could we see it in February, March, April? Yes, but I think what we'll see more than likely is we'll see the Bank of Canada say in January if they're moving up the timelines, and that will be the best indicator of when we'll see the first interest rate increase. It probably won't happen in January. And for the most part, when you take a look at the normal news, Bank of Canada holds on rates, warns of elevated inflation. We're still talking about elevated inflation here. We're still talking about it taking until about the middle quarters of 2022 for that to go away. Bank of Canada is very much expecting that we're going to see high inflation for the next 6 months, and then it's going to come back down to 2%. Now, this is what they've been saying for almost the last year, which becomes a little bit concerning because is that inflation actually going to go away? And I have to think there's some supply issues that are very clearly having an effect on inflation. We need to pay attention to that. Some bright news, some good news on the horizon is that energy prices, because of the new coronavirus variant, have started to come down slightly, which will take a little bit of pressure off inflation. And the expectation of higher interest rates is also probably going to take a little bit of the pressure off of the market, especially considering that a bunch of 5-year fixed rates have increased over the last couple of months. And if those remain high, eventually the lower 5-year fixed rate holds will run out. And then that should start to limit the amount of buyers that we see rushing into the market in those first quarters. And then if we see some stabilization come to housing, we see some more reasonable energy prices, and we see supply issues start to work themselves out, then we should start to find ourselves in a position where inflation is becoming lower. At least that's the common sense thinking, and that's the thought process here. Now, here's the thing. Economists are really good at making predictions. We're really good at taking the data we have today and making forward-looking predictions. But obviously, the world changes on a fairly frequent basis. It changes faster than it ever did before. And I fully suspect that between now and the next interest rate increase, we're going to see lots of changes to the forecast because we're going to see lots of changes in the economic data. So the question I always get is, what should I be doing? Should I be locking in? And the answer right now for me is probably not, because here's the deal. If you were to lock in right now, you're going to lock in at arguably elevated 5-year fixed rates or 4-year fixed rates or 3-year fixed rates. You're going to pay a pretty substantial amount over the variable that you already have. So until that variable and those fixed rates start to come to where they're pretty much in line, I would be sticking long-term to a variable rate. There was a podcast in the mortgage industry from several of the big mortgage brokers across the country in the last couple of days, where they're still talking about variable versus fixed, and they're still talking about the fact that it would take 5 interest rate increases, at least maybe 7, before you start to have your variable rate cost more from an interest rate perspective than what the fixed rate you could get right now is. But you also have all the time between now and when interest rates start to equal that amount where you're going to be saving money. And therefore, you'll have 4, 5, 6 interest rate increases after you get to where 5-year fixed rates are right now, where you would have to have them go up that many times before you're worse off, because you've got all this time that you've been saving, so you have some room on the upside. That's why Variable rates tend to make so much more sense than fixed rates, especially when you have a large gap between variable and fixed at the time you get the mortgage. Not to mention the fact that you have significantly lower penalties typically on a variable rate, especially if you have a big bank mortgage. The 5-year fixed mortgages, even in an environment where interest rates are going up, can tend to have large penalties, even though the going rate on the market may be higher than what you actually borrowed for. So here's the reality of the whole situation is we don't know until we know. January is going to shed some light. As of right now, we're still at the exact same position that we were at a month ago or 2 months ago with respect to when interest rates are going to increase. Obviously, we're getting closer to them actually increasing. Every single day that goes by, we're getting closer and closer to an interest rate increase. We just don't know when that increase is going to happen. Right now, best guess, earliest is April. That may change in January, but more than likely expect that it's going to happen sometime between April and September of next year, if it happens at all. So that's our video for today. If you found it useful, do me that favor, hit that subscribe button, hit that notification bell. Please hit that like button so more people like you can see this video. Don't forget about our race to 25,000 subscribers, and we'll see you on the very next video. Cheers.